My name is Ashish Somaya. I am the Managing Director for Motilal Oswal Asset Management Company. On behalf of Motilal Oswal Financial Services, Motilal Oswal Securities, Motilal Oswal Private Wealth, Motilal Oswal AMC, the entire MOFS family, the whole 2,800 of us, I would like to give all of you a warm welcome. Thank you very much for turning up here in large numbers and well before time. And thank you for taking your seats. So this is something which we are very, very proud of, annual event, and it's the 21st wealth creation study. For those of you who don't know, this wealth creation study has been going on since 1996. Okay. In fact, today Raamdeo ji and me were having a corridor conversation where he was telling me that there are many aspects of the stock market to study, and he was saying he wishes that many people would work on processes and philosophies and come up with similar studies. I was just telling him that because of his track record of 21 years unbroken, it makes that much more difficult for anybody else to start it or emulate it now. Because if it was 2 years, 3 years, 4 years, it's a different story. But 21 years. And just to give you a little bit perspective about these wealth creation studies, there are many researchers, many broking companies, many academicians. There's a lot of research on sectors and stocks and macroeconomy. But there's not enough research on what actually works in stock markets. A lot of us have been from management schools or B schools, and a lot of us have read stuff like Good to Great and Built to Last. These are books which are written maybe once in 10, 15, 20 years, where someone tries to make an endeavor to understand that what makes the best companies tick. So if you are late to the party, and if you do not know what actually wealth creation study means, whatever I have understood, it's a pretty tough job, because it's like writing one Good to Great every year of your life for the last 21 years. So I would like to congratulate Raamdeo ji for the 21st wealth creation study. So, this Motilal Oswal wealth creation study is like an annual event, and these, time periods from say August, September, October, November are very difficult periods for people like me and our colleagues, because we can't get an appointment with him, because he pretty much locks himself up with his team for at least 2 to 3 months and delves deep into a chosen topic. Because every month he reads 3 to 4 books, and he comes up with a particular topic of interest, and then the last 3-4 months of the year are dedicated to going deep into a particular topic. So this is an annual event that presents a unique looking back and looking forward perspective to the Indian capital markets. Based on research data of the past 5 years, the first part of the study determines the biggest, fastest, and most consistent wealth creators, and then the second part of the study looks forward to provide an insight in some of the big trends which will impact our markets possibly in the coming years. And after this study presentation, we'll be having a panel discussion, and the panel discussion will try to bring out further learnings from this study and previous studies. So I won't take much of your time. To get things rolling, I would first like to invite our chairman, Mr. Motilal Oswal, to make the welcome address. Please join me in welcoming him. Thank you.
Good evening, friends. A very, very warm welcome to you all. It's really a moment of pride for me and many of us for this 25th Wealth Creation Study presentation. 21st, right? Or 22nd? Friends, as it is said that the deeper you dig, the higher you climb. And that's what Raamdeo does year after year, not for more, not for 21 years, but now for more than 33 years. 21 years just the research and formal documentation, but we have been practicing for now more than 3 decades. And this is impacting huge number of our customers, about 1 million in broking as well as in, I think, asset management. Our AMC manage about 15,000 crores worth of assets, which includes both PMS and mutual fund. But even much higher amount is impacted through our broking, where we have about 40,000 crores worth of DP assets. And apart from that, we also manage the assets in real estate as well as private equities. So all this knowledge, what we have accumulated over the period of years, is being really used for creating the wealth. I think this 21 years, 21 themes, every study would have different themes. And many of them are path-breaking themes. So the knowledge which is created here actually is really applied in real sense. And that's what this differentiation we have been, I think, using for building not only the asset management businesses, but all across the businesses. This year's theme, focus investing, I think we as a firm, very focused in financial services business, and I think focus is what Raamdeo loves, and focus is what actually we apply in every facet of our business. So friends, I'm very happy to see all of you here, and I'm sure, I think, with Raamdeo's presentation and after that, the discussion is going to, I think, a lot of insights about this focused investing. I think so far, most of all the studies were about what to buy. Now, for the first time, Raamdeo is now talking about how much to buy. And whether the asset allocation, I think, into particular stock makes difference or not, I'm sure, I think, next time he's going to talk about how to sell and when to sell. Thank you and welcome again.
Good evening, friends, and warm welcome to Motilal Oswal Tower and my convocation function of 21st study. And for me, it is one of the very special day in a year that I get an opportunity to speak to all of you and welcome you here and part with you. Actually, when I present this, I think most of the learnings come when I present to you and many other places. Because after 2 months of study, we are stuck with our own thought process so much that internalization has to happen, because for practicing any new concept, you need to have as part of your life, like the way you do the calculations, 1 + 1 = 2, like that, all these concepts, they look a little abstract, they are a little difficult to practice, but once you keep talking about it many times, I think it becomes part of your life. Like we call it QGLP. I mean, for a lot of people, it takes so much of time to say even QGLP, but for us, it's a way of life, you know, when we look at any company and all. So this year's study is a very different study. This year, we have decided to look at power of allocation, the second engine of wealth creation. The first engine, of course, is about what to buy. If you buy right and sit tight, in any case, you can make money. But if you buy right and allocate well and sit tight, the difference which can be made, and it is being made in many portfolios, is staggering. I mean, if you look at what Buffett has done, that over a period of time, or Manjar has done, or all the big guys who have practiced, as Ramesh said, the concentrated strategy. And what they could do in their early years. I mean, important thing is that what you do in early years, because in compounding, it is important that you start well. If you don't start well, in that case, the impact on the compounding at the end of the career is going to be very different. So let's get on to understanding all the facets of power of allocation in wealth creation. This is the today's presentation is in two parts. First is briefly about the statistical analysis of last 5 years, which are the companies which have created wealth and how much they have created, from which categories they have come, and how the markets have done in this period. And then second part is the focused investing, which is the theme of the study. So the very concept of wealth creation is a process by which any company enhances the market value of the capital entrusted to it. And it is a wonderful process of wealth creation. Typically, investors give very small amount of money to the companies, and the companies create hundreds and thousands and lakhs of crores out of literally nothing. That is wealth creation. Like if you look at Infosys, look at TCS, look at iShares, look at HDFC Bank, barely few hundred crores have been given to them to start with, even at the time of public issue. And today, next 15, 20 years, they have created lakhs of crores of market cap, and on top of it, thousands of crores of dividends have come, and many more thousands are in the pipeline. So, concept of wealth creation is very powerful. All over the world, this is the biggest game. All the rich people, all the richest people in the world, they are rich because of they have been able to enhance the value of their capital to in the beginning to a very large disproportionate sum in next 20, 30, 40 years. Net wealth created concept we have created, change in the market capitalization over the study period, that is 11 to 16, 5 years, adjusted for any corporate raisings of money which they have done during the period. It's very simple. We are not tried to do any kind of time adjusted, but end market cap reduced by the beginning market cap, and if there is any money they have raised during the period. So we have three categories: biggest wealth creators, fastest wealth creators, and most consistent wealth creators. So this time, the biggest wealth creator, the top wealth, three categories, and the amount of wealth created by these top 100 companies are about 28.5 lakh crores. So it's quite a big wealth creation, but for last 3 years, the amount of wealth creation remains stuck because market has not moved anywhere. But it's still 28 to 30 lakh crores over last 5 years in a flat market is quite credible. So the message is that though the market has not done well in last 4-5 years, but the stocks have done very well. There is no dearth of wealth creation in the stock market, despite the fact the indices are not moved. The indices have done at about 5% between 11 and 16. BSE Sensex have moved at about 5% compounded, whereas the 100 companies which we are talking about, they have done about 18% compounded in last 5 years. The biggest wealth creators are TCS, HDFC Bank, Hindustan Lever, ITC, Sun Pharma. That's how the list goes. And TCS has done about 2,63,000 crores. I mean, we lose the sight of what can happen in 5 years. But this company in 2011 was capitalized at about 2,31,000 crores, which has become almost like 5 lakh crores. So it has grown at the rate of 16% compounded, almost double in 5 years. HDFC Bank, this has been really climbing right from 96 when it was literally nothing. It took a birth at about 1,000 crores market cap. And now today it is 3,25,000 crores, threatening the first position of TCS. And after 2 years, it has moved to number 2 position in size of wealth creation. And it is the most potential candidate to become largest wealth creator in next 2-3 years. The fastest wealth creating list. This is what is the most aspirational and most wonderful, and one must find few stocks from this list into one's portfolio. Ajanta Pharma is up 53 times, literally growing at more than doubling every year, and from 235 crores, literally nothing, to 12,000 crores as of March 16. Now it is more like 17, 18, 19,000 crores. Wonderful job in last 5 years. Welspun, which is a tremendous turnaround in textile industry. One is the turnaround and second to that too in a textile industry from done 23 times, starting from 400 crores to 10,000 crores. Eicher Motors, this is the almost fifth year consecutive that it is in the fastest list, and it was about 4,000 crores, 3,500, and now it is 51,000 crores. I mean, it was, so it has done about 14 times in the last 5 years. Like this, we have Bajaj Finance, which has grown at about 39%, and price grown is about 59%, yeah, 59%, and it has done tremendous job, and it has grown even more after the 31st March. So, typically, you see the size of the companies, I mean, in third column, that most of the companies, 6 out of 10 companies are less than 1,000 crores at the beginning of the study. 5 years back, they were about 1,000 crores. So it is very important if you want super multi-baggers, 10 times, 20 times, 30 times, 40 times, I mean, you need to start at a, I mean, necessarily you have to start at a very modest stock. I mean, at that point of time, you will not find any FIIs or most of the institutions are not present in the stock. And at that point of time to buy these stocks and put in the portfolio is extremely important if you want. And happily, Ajanta Pharma, Eicher, Kajaria to some extent, Bajaj Finance in large way, and Amar Raja Battery. I mean, these are the stocks which are found in PMS and mutual fund portfolios of Motilal Oswal AMC. The most consistent, this is the third most prestigious category of wealth creators. Asian Paints, I mean, it is staggering. 30% compounded for last 10 years. I mean, this company really deserves to be top and most consistent wealth creating company. And more importantly, the franchise, the ROE, return on equity, in the last 2 columns have remained at 31. And it is, you see others, most of them, they have lost their return on equity between 6 and 16. For 10 years consecutive, to remain at 30+% is quite an achievement. I think there is another company which has, and second one is the HDFC Bank, which has maintained the franchise at about 16-17%. Rest all, they have lost the size of franchise they have. So what is important is that mostly 8 out of 10 are consumer facing. That's why consumer facing companies are very, very powerful and very valuable in India. And consumer boom is yet ahead. So these companies might take up bidding for some time right now because of their expensiveness. But the very core idea that they're facing the consumer, they will keep creating wealth at a little faster pace or a little slower pace, but they will be there in the marketplace. Consistent wealth creation is equal to sustainable and profitable growth. That is the core cornerstone of this kind of companies which are found in this list. And this typically comes from fantastic business run by fantastic management team. I mean, both are non-compromisable. Sensex has done, as we said, 5% compounded. It was about 20,000, 19,500 in 11, and now it is about 25, 26,000. So, and Sensex has not moved at all. I mean, just about 5% compounded. Whereas these companies, they have grown from 19,000 index to more like 46,000, literally doubled in 5 years. The kind of businesses which have done very well, clearly consumer and retail have done exceedingly well. They have contributed 22% of the wealth created, and they were not so big in 2011, but in 2016, it has contributed the highest. Banking and finance has to contribute 18%. Technology has been 17. Autos have come back with a big force at about 14, and healthcare is about 13, more to do with the export-oriented pharmaceutical companies. So, my sense is oil and gas is one sector which is kind of small right now, only 2% contribution. As we go forward and the deregulated environment comes into being, I think we'll see more prominence coming into this segment and more wealth being created from here. Public sector banks, public sector units, which was in commanding heights in 2000 to 2005, at the turn of the century, 40-50% used to be coming from multinational companies, and another 40-50% used to come from public sector undertakings, which were about 100-120 companies. Now, it is reduced to just about 5-6 companies. and only 4% of the entire thing is coming from, wealth creation is coming from here. So this segment, it could be completely contrarian, but it looks that they have lost the plot, and all the public sector banks and all the companies, they seem to be in a very bad shape in terms of wealth creation. This is segment of, these are new slides into the wealth creation study. This come from mid to mega, where what happens is that we have categorized the companies in top 100 we call it mega, next 200 we call it mid, and 300 to 500 we call it mini. So if you see, bulk of the wealth creation has happened when the companies have moved in size from mini to mid. The 67 companies, the center left, you know. So the 67 companies have grown at 39% compounded. So very small companies, when they move from mini to mega category, so that when the ranks change, they create wealth. So 67 companies have moved from mini to mega, and all of them couldn't find space into wealth creation study because of their smaller size. But 15 out of 67 have found place into wealth creation studies. And 26 mid-sized companies from 100 to 300. So out of 200, 26 companies. So almost 12% of the companies have moved from mid to mega, and they have done 31%. So this is the most fertile segment of wealth creation, and finding the companies out of 200, another 25, 26 companies is much easier. And because the mini companies are there, so many of them, thousands of them, it is difficult. They look to be more exciting, but the real place to find your next wealth creators is the mid-sized companies between 101 to 300. And if you see the left bottom two in the red, there are two companies which have gone from mega to mini. They have lost 85% in last 5 years. And those two companies are OBC, Oriental Bank of Commerce, and JP Associates. So valuation, if you look at the valuation metrics, we are seeing for last 2-3 years that the P multiple is, I mean, earlier it used to be, if you buy low P multiple, you used to make a lot of money. And higher P multiple used to be expensive companies, they were not making money. But if you look at here, less than 10 P multiple, of course it has done somewhat better at 23%, but right even above 30 P companies, they have done more or less same, about 20-21%. So there's not much to see in, I mean, it's not necessarily low P multiple company will do well and higher P multiple companies will do worse. I mean, this is a conventional logic which should work, but it has not worked it has not been working for last 5-7 years. We are seeing this change in the studies. The only thing which seems to have worked is a payback ratio which we use here in Motilal Oswal. If the payback is less than 5 years, payback ratio is equal to market cap divided by 5 years forward PAT. It's slightly forward-looking growth adjusted ratio, but if it is less than 1, decidedly it has given 40%. So if your peg is 1 and the growth keeps continuing for next 5 years, is the surest possible way to find a multi-bagger. So less than 1, 39%, and above 3 is also 16% growth adjusted. So I think beyond that, I mean, to pay, if company is growing at 30% and you pay 70-80 P multiple, then only you start losing. But if you are able to pay, if you can find a company which is going to grow at 50%, even if you pay 60 P or 70 P, still it will make a lot of money. The issue is, can you really foresee the growth of 50% for next 5 years? The companies which have destroyed most of the wealth in last 5 years, all of them, either they are public sector undertakings or they are commodity companies. And they have lost in all about 6 lakh crores and, 15, total wealth destroyed is about 15 lakh crores, and this top 10 have destroyed about 6 lakh crores. This staggering amount of money, if you get the stock wrong in your portfolio, this is the problem with the stock market. It is not one-way traffic. I mean, there is a possibility of making a lot of money, but there is also a possibility silently that you can lose serious amount of money. So, So coming back to the main theme of the study, power of allocation in wealth creation and focus investing. As I said, we have spent 20 studies on what to buy. And this study is dedicated to how much to buy. Now, this thought came about because in our own company, in AMC, what happened was that this Bajaj Finance and Aisha, these two companies in one portfolio was held, one up, because of SEBI restriction, but more even out of a deliberate allocation, it was held at about 5-6%. And in another portfolio, it was held at about double digit, 12, 13, 14%. And the performance differential eventually for the portfolio, despite in the first portfolio, many more companies did well, but because of these two superior performance with superior allocation, the performance difference was more like 10% per annum. And that prompted us to think why exactly this performance differential? And then we realized that stocks were same. We have the same stocks broadly in all the portfolios, but the power of allocation. And that made us believe that let's look at this particular power. And then I was thinking, what exactly is required in making money in the market? One is what you buy and how much you buy. And at times I think, Rakesh is made up of how much to buy, not so much about what to buy. His success in Titan, his success in Lupin, his success in, I know him from 85. I think the biggest difference between, there are so many more smarter guys around him and in the market, but the difference between others and him is the allocation. He buys, like somebody will buy 25,000 shares, he'll buy 25% of the company. That's the fundamental difference. And rest all, it turns out to be a story. People love him. And so that's the story of allocation. And let's see how exactly we can improve upon our allocation strategy. So this is the example of a 10 stock portfolio where top 5 stocks are going down from, their positive turnout, 50%, 40%, and then last 4 are going negative. Portfolio A has 10 stocks, all the 10 stocks, but equal weight. So it will do about 5% return. Portfolio B will start with 20% for the stock 1, and then it will keep going down to 5% for the last one. It gives you weighted return of about 18.5%. Portfolio C does just the reverse of portfolio B. Where portfolio B has 20%, it does 5%. You start from the lowest and goes to the highest. You see the performance differential. The equal weight does 5%, portfolio B does 18.5%, and portfolio C does minus 8.5%. The same stocks, all the stocks are in all the portfolios, and yet the outcomes are from minus 8.5% to plus 18.5%. An equal weight could have given you about 5%. So the gap between performance could be quite staggering with the same stock, but different allocations. So power of allocation is quite huge. Your performance could be the 5%. If you take it as a mean, it could be more than double on either side, if your allocation is right or wrong. So, but then this subject is extremely under-researched. Despite it is the biggest game in town, and a lot of people have tried to look into this subject, but when we looked around in academia, and we spoke to a lot of brilliant guys, and very dear Sanjay Bhattacharya also. So we found that there is very little meta in this subject available, and all the books, they harp on, what to buy much more than how much to buy. There is very little discussion in most of the books. Kelly formula is the only one framework which is not mathematically, it is not that much useful for the stock situation, but it gives a semblance of how you should look at the bet sizing. This formula was done by John Kelly in 1950s. He was a Bell Lab scientist and developed a formula to maximize bankroll in gambling situation. When you play blackjack, how do you make a lot of money out of your bankroll? So they came out with a formula, and the formula was BP minus Q divided by B. It's very simple. Just take 30 seconds and try to read that. F is equal to fraction of bankroll to be put into action or bet on the floor. B is net odds or win or loss ratio. B is like 5:1, 3:1, how much you will win or lose. For a rupee of loss, how much you will win, 5 rupees or 2 rupees or 1 rupee. And P is probability of win, Q is probability of loss. So if you, actually it is how much you win when you win, how much you lose when you lose. So it's very simple. Once you are able to do this, so I'll just give an example. So you start with a bankroll of 1,000 rupees. You have 1,000 rupees to go on the casino. If someone offers you a win of, every time you win 200 rupees, and if you lose 100 rupees. It is 2:1 bet. So the way it has to be played, you can't play 100 rupees out of 100 rupees despite the fact that the upside is 2 times. Whenever you win 2 rupees. Still you can't play, you can't put the entire 100 rupees because the probability is 50-50. So it is good, quite possibility if you put 100 rupees and you lose in the very first time, you'll be thrown out of the casino. You'll not have money to play. So the important thing is you play only 25%. As per the formula, you play 25%, even if you keep losing, and 25% of the remaining what you have. So if you lose very first time, it will become 750. So you play 25% of 750. Then you will win, and then you will win. So it will keep growing. After 30, 40, 50 times, your 1,000 will become many thousands, like 5,000 or 10,000. So that's the formula he gave. And so this is the only framework for deciding how do you bet in a stock market. Now, stock market situation is very different from equity markets. So what is the difference? The difference between stock market and casino is payoff is not given. Probability and payoff both are not given. When you go to casino, you know it is going to be one-time win for one-time loss. If you win, your 1 rupee will go to 2 rupees. If you lose, that 1 becomes 0. So probability and payoff both are known in casino. It is not known in stock market. Third, nature of bet is sequential. You know, you do one by one. Here, entire 100 rupees is put into action immediately, simultaneously. There, it is in 30 seconds when they open the bid. When they throw the dice, the win or lose happens instantly. Whereas in investing, you can hold it for 1 year, you can hold it for 3 years, 5 years, 10 years, and like Buffett, you can hold it forever. So you get a lot of time for your bet or investment to decide its outcome. And then because because there is in casino situation, typically the casino doesn't leave the favorable situation for you. The bets, your probability is 50-50 and your payoff is also 1-to-1 typically. You don't have any edge. You don't have any advantage over the casino. And that's why you never win. And that's why whenever they throw the cards, they say good luck. The dealer is always tell you good luck. The only luck works in casino. Whereas in the stock market, you cannot undermine the role of luck, but it is luck and skill. This is one place where in the stock market, the skill is important. And luck is, of course, if you are doing some business and the luck favors you, it is very good. So, Kelly's formula adapted for equities is the amount of money you must bet is dependent on upside UP minus GQ divided by U. So upside, how much is the extent of upside multiplied by probability of upside and reduced by downside and probability of downside. So what is important here is to just look at 3 things. What is the essence of this? Because mathematics is not important here. What is important is how much is the upside. When you look at a situation where 100 can become 1,000, 10,000, 15,000, when you see, very rarely you get an opportunity where you, with your understanding, see, the probability and payoff, both have to be decided by you. In casino, everything is given. Here, the art starts from the probability of win to the probability of, and extent of win. So the moment you look at the favorable situation where you realize that there is asymmetric payoff, the upside is massive and downside is limited. We'll give some examples of that. But once you realize that there is upside is huge and downside is limited, create an edge. The probability of win is high and try to make sure that you are in that kind of situation. You create an edge. And once you have the edge in the payoff situation, asymmetric payoff situation, you have to bet big. So huge upside, limited downside, and probability on your side. Once you have this situation, you must bet big. So that's the basic essence of Kelly formula. Now we call it PUD, probability of win, upside, downside. Once you check these three things, if your probability of upside is high, upside is high, and downside is limited, you are in the situation to bet big, because this is the asymmetric payoff situation. Now I'll give you some examples of my own experiences in the market, like in Hero Honda in 95. The situation was, two-wheeler market was booming, the opportunity size was very big, 100cc motorcycle was replacing very rapidly the scooters. There was actually 3,000-4,000 rupees premium on every bike, and it was a combination. The management was the combination of Honda from the world's #1 bike company and Hero, which is the terrific marketing company from Delhi. Market cap of this company was just about 400-500 crores. And P multiple was reasonable, about 23, ROE was 28%, and payout was 25%, and growing very rapidly. So in my mind, terrific business with terrific management at reasonable valuation, and growing very rapidly. So in my mind, upside was very high, downside was very limited. We were likely to make good money. So what happened in the next 5 years? Sales grew at 36%, profit grew at 57%, market cap grew at 54%, and price grew at about same 53%. So here you see the situation. Probability to win was very high because they were gaining market share continuously against Bajaj Auto and any other manufacturer. And you could see in the marketplace there was a premium on the bike. And it was not an unknown thing. It was known to everybody. Upside was massive, downside was limited. You were buying at 15 P multiple, sorry, 23 P multiple. 450 crores for world's #1 bike company selling their brands. So we thought downside is limited, upside is massive, let's bet. The unfortunate thing is I bet only 2-3% of my portfolio. And then also I made a lot of money. You just imagine if I had just double the size, instead of 2-3%, if I had put 5-7%, that also would have made significant difference to my end portfolio valuation, which went to almost like 80-90 crores when we sold it last year. Second, Bharti Airtel. Massive migration. Look at the upside possibility at that point of time. Massive value migration from wired to wireless telephony. Bharti was a clear market leader because it was a network business. You have to bet on the #1. Sales of the company was just about 3,000 crores, growing literally at 100% every year. So upside was quite massive. Market cap was just about 5,000 crores. Of course, it was not making profit, but the calculation was that it is unlikely to make major losses because IPO had come at 45 rupees, the stock was at about 21-22 rupees. So the downside had already happened. It was very unlikely. If the business was successful, the likelihood of downside was very limited. And probability was very high that this company will make a lot of profit. What happened in the next 5 years? 2003, January, we bought the stock. The sales went at 55% compounded from 3,000 to 27,000 crores in 5 years. PAT, which was negative at 200 crores, went to 6,520 crores, 50 crores in 5 years. Market cap grew literally every year. And we made almost 40 to 50 times in 5 years. So when you have, but then what did I bet? I bet only 3% of my portfolio. Again, we couldn't use the opportunity because I wish I had done this study 20 years back. So Ajanta Pharma, more recently, again, I think I was a little wiser this time, operating in profitable niches in India and abroad, very large opportunity, disciplined management. In fact, we thought initially that it is not a disciplined management. In the second round, we realized that it is a disciplined management, growing very rapidly and available at very low P multiple, at about 14-15 P multiple. Value migration in pharma and nascent company. What happened here? In fact, we bought it even earlier than that, but sales grew at 20%, profit grew at 32%, so, and price grew at about 88%. This is completely unexpected, the P multiple going from 15 to 31. So again, probability of win was high, upside was very high, downside was limited. So whenever you get this kind of asymmetric payoff opportunity, you got to bet big. Bet big means it does not mean 30-40% what Buffett could do for American Express, but at least what you are doing with 2%. Most of the guys, I asked few guys, they said, I spoke to a lot of people about the bet sizing. And some people, they said, we buy as much as cash we are left with right now, because my money is already committed to the rest of the portfolio. Somebody says, I typically buy equal weight. If I have a 10 crores, I'll keep buying 40, 50 lakhs to start with. So they don't bet size depending on the possibility of the win. So it is important to see that you allocate very, with a very determinate mind that, okay, I'm putting here 5% or 7% or 10%. Then only the difference is going to be made. So Kelly's second insight is, one is the huge upside. Second is having an edge. I mean, that is what really makes a difference between an investor and the superior investor. So how do you create a superior knowledge over the market? One of the crazy thing about the stock market is that it is listed in the market. And when it is listed situation, lot of pluses or advantages of the company is known to the market and it is built into the price. So your knowledge has to be superior to the market, and that is called edge. And how do you create an edge over the market? So there are two sources of creating an edge: informational edge, and second is analytical edge. So information edge is when you talk to the dealers, suppliers, competitors, employees, and friends, and you can talk to any number of people, and you can get some information about how good or bad is that company. Second is quality and frequency of management interaction. How at what level you interact and how intensely you are able to interact with the management. So this gives you information advantage. But in current situation of digital situation, this advantage is very dim. The real advantage comes from the analytical advantage, where you have all kinds of analytical framework. Porter's 5 forces model for the competition analysis, our own next cylinder opportunity, role of industry tailwind, value migration, quality of management, terms of trade, power of compounding, and then whole lot of other things are there. I think power of compounding is, it's a massive compared to understanding power of compounding and actually realizing what it takes to get 25-30% growth for next 5, 7, 10 years is really crux of the thing. So you got to have both of them. That will help you to get the edge which is required to bet big. So third is when you have these two, huge upside possibility and probability of your success being high, your edge is very high. At that point of time, you bet big. Now, investing is a unitary approach. It is not a committee approach. What happens is that 5 guys cannot become a committee to manage a fund or a corpus of money. It has to be single person taking care of the money. And in that case, what happens is, it is very difficult for a fund manager to figure out many places where the payoff is going to be huge. So asymmetric payoff opportunities don't come that easy to an individual. He can get 5, 6 opportunities, 7 opportunities, 10 opportunities. There are very few opportunities you get even in 5, 10, 15 years. And that has to be understood. And hence, that edge is limited by the person's capability. And hence, you cannot have many situations in your portfolio. So your portfolio has to be necessarily focused. And we'll talk a little more about this. So there are 3 types of strategies to manage your portfolio. You can have a very diversified strategy, as Ramesh told about, where the bulk of the 80-90% of the global money in India also, will tell you about India's situation, is put, and all the clients' money is put here, and number of stocks are typically more than 50. Volatility is low because the risk is defined as low volatility. So clearly they try to kill the risk portion of it, but then return becomes low. Return becomes just about 1 or 2% above the index. So return is acceptable return. It's not very low, but it's just about 1 or 2% above. Other side, on the right side is a concentrated investing where return is exceptional, hugely exceptional. Volatility is high, because yearly there could be a big up and down. Number of stocks are 10 or less, 3, 5, 7, 8, mostly 10, 12 stocks. So that's also not, so this suited for these two, this strategy is suited more for the private money, not for the public money. So the golden mean we are trying to talk about is the focus investing, where number of stocks are between 15 to 20, volatility is medium, it will not be very low, but as per the theory, beyond 15, you don't have much benefit of diversification. So volatility, I would say, is low to medium, but return could be exceptional, depending on the manager's edge in knowing his stocks. So we are saying the golden mean is focus investing, and what it takes to practice focus investing. In India, about 4 lakh crores is there, 286 funds, 13%, about 36 portfolios, very small portfolios, have about 14,000 crores, which is about 3% of the total AUM into the focus strategy. Rest all are put into more than 25 stocks. And so focus strategy is very, very, it's not being practiced actually. So, what it will take for the managers to go to more focus, I mean, from 50 to 40 or 30 or 20, that is the way, but I think at some point of time, I mean, we manage 3 funds. I mean, half of this 40,000 crores is Motilal Oswal funds only, but and other half is the rest of the 33 funds, which basically don't bother about it. So this strategy is focus strategy, and if you look at the volatility or return, you can see the difference. But it will take a while to turn this trend, because not only in India, even world over, in America, which is a very deep market, in fact, it is even more diversified. People have 100, 150 companies. Return 85% of the funds, they underperform the benchmark. And yet they survive, and that's the way people are going. And probably that is the reason, out of frustration, people are going to finally index funds or passive they are becoming. But the world is not changing. The fashion is not to do focus investing, because it requires a lot of hard work at the end of fund manager to create an edge and take the risk of his reputation if it doesn't work. So what are the characteristics of what it takes to practice focus investing? Clear portfolio goal, superior stock selection, rational allocation, and active monitoring. So clear, in 1964, Buffett said, we have to work extremely hard to find just a very few attractive investment situations. Such a situation, by definition, is one where my expectation of performance is at least 10 percentage points per annum to the Dow. In 64, he decided to have a target of achieving more than 10 to, actually it is 10 to 15% above Dow. And you see what has happened from 65 till 2016. In next 50 years, the old man has delivered exactly 10% above Dow, 19.5% return, whereas the Dow is 9.5%. So this is the power of targeting. We keep talking about doubling in 3 years. I mean, I don't think we can do it forever, but that's the target. So having a target in the portfolio, or even managing the wealth, it is extremely important to have the purpose or the target or portfolio goal must be there. Whether you want to earn 15%, 20%, 25%, it will, your strategy, selection and allocation, both will be dependent on the target. Next, superior stock selection. Our 20 studies have gone to QGLP, a way of, selecting a stock, and I would not go into detail. It's a full-time presentation on this, but QGLP is the way, as far as we are concerned, to select right stocks. As far as rational allocation is concerned, we talked about Kelly formula, and the suggested method is a confidence-adjusted payoff. I mean, in the study you will get to see more in detail, but basically what we are saying is you estimate your payoff metrics, upside, downside, and then decide on number, and then further you adjust to your confidence level to that number, and whatever it comes, you put a stack of it and then allocate in a descending order. So this is how one of the portfolios, it could be a suggested portfolio of say 3-year upside in column 1, confidence sector 90%, 70%, 100%, whatever, and this will give you, for whatever reason your confidence factor is lower, then you can decide the allocation. And then that's how you have to build a portfolio. and you see the end result will be more like a 20-25%, whatever you want. So depending on that, your allocation will increase or decrease on a particular stock. Common stocks of misallocation. What happens is the allocation is such a thing where, one of the biggest source of misallocation is underallocation. Whenever you get an idea, the idea is new to you, you are scared of losing money on that, so you buy very little. That's the biggest mistake people commit. When they get the really a multi-bagger, they buy very small quantity. As I said, somebody buys 25,000 shares and somebody else buys 25% of the company. So that's what really makes a difference. Second is over-allocation. In the heat of bull run, you become so confident that you over-allocate into a stock, and the stock slumps because the stock, all the information is in the price, and that again hurts your portfolio. Third is overstaying with the winners. This is a very common mistake. Most of the people commit that. Once there is an ownership bias, in the sense that once you are very successful, stock has gone up. Even I have suffered from this. Once it has gone up by 20, 30, 40 times, stocks cannot go again from there 20, 30, 40 times. You are celebrating your success and you stay with the portfolio, and portfolio doesn't perform with the market. And fourth is overstaying with the losers. Your stocks are not done well, and your current price is lower than your purchase price. You become forced long-term investor. So again, you don't correct your portfolio. So these are the four known sources of misallocation in the portfolio at the cost of overall portfolio performance. Active monitoring. This is something which private investors just don't do it. Just don't do it. This is one area where people have to come back and do it in a professional way. In fact, the professional guys, they do too much of it by the hour, by the minute, by the day. But the private investors, they just don't do it. So monitoring helps you achieve the excellence. Look at the Michael Phelps. How he's being, before going to Olympics, the trainer, he keeps monitoring every fraction of a second. And that only brings excellence. So monitoring helps you achieve excellence. So you just can't undermine the power of monitoring in portfolio management. In conclusion, stock allocation is a powerful tool for portfolio performance, but is under-researched vis-a-vis stock selection. There's too much of pressure on the stock selection, but not enough on the stock allocation. Kelly's formula offers 3 insights for equity investing. Look for asymmetric payout, huge upside. And if you have an edge there, then bet big. You have to keep looking for the situation. It comes very rarely, very seldom. Once in 3 years, once in 5 years, but we are habitual of looking for ideas every day. Opportunities for big bets come seldom. Focus investing is sound strategy to capitalize on them. Keys to successful focus investing are clear portfolio goals, superior stock selection, rational allocation, and active monitoring. Disciplined practice should lead to exceptional returns rather than acceptable return. Because the very purpose of coming to the market is not acceptable return. The purpose is to earn exceptional return. And this is one of the strategies we propose. Thank you.